The world's biggest technology companies are spending hundreds of billions of dollars building artificial intelligence, data centers, chips, power, networks, and much of this infrastructure may be essential if AI develops as quickly as companies expect. But there's one question investors eventually need answered. Will AI make enough money to pay for all of it? Because if the answer is yes, today's enormous spending could help build some of tomorrow's most valuable businesses. But if the returns disappoint, the size and increasingly the financing of that spending could become a problem. This video is for education only and isn't financial advice. We're not trying to predict whether AI will succeed or whether technology stocks will rise or fall. Instead, we're going to follow the money, how much is being invested, where it's going, how some of it is being financed, and what investors can watch. First, one term we need to understand. CAPEX means capital expenditure. It's money a company spends buying or building assets that it expects to use for years. Imagine a manufacturer spending money on a new factory. That's CAPEX. For the AI boom, think data centers, computer servers, networking equipment, power infrastructure, and most importantly, huge numbers of advanced computer chips. These aren't ordinary day-to-day expenses. They're investments in infrastructure that companies hope will generate future profits. And this is where the story becomes unusual. The biggest technology companies are now spending extraordinary amounts building AI infrastructure. Companies such as Microsoft, Amazon, Alphabet, and Meta have dramatically increased investment in data centers, chips, and related infrastructure. And when several enormous companies are all expanding at the same time, we're no longer talking about a few $billion. We're talking about hundreds of billions of dollars every year. That doesn't automatically mean they're spending too much. Demand for computing power is enormous, but the bigger the investment becomes, the bigger the future returns eventually need to be. It's easy to hear AI spending and imagine companies simply buying more computer chips, but the infrastructure is much larger than that. AI needs enormous data centers. Those data centers need land, buildings, servers, networking equipment, cooling systems, and huge amounts of electricity. That can also mean new power generation, substations, and transmission infrastructure. So an investment boom that begins with software and computer chips can spread into construction, utilities, energy, cooling, and industrial equipment. AI isn't just a technology story anymore. It's becoming an infrastructure story. Before looking at the risks, there's an important point to make. Huge CAPEX isn't necessarily bad. Amazon spent enormous amounts building logistics warehouses and cloud infrastructure. Today, Amazon Web Services, or AWS, rents computing and data storage capacity to businesses around the world. So Amazon isn't only the company that delivers parcels to your door. It's also one of the world's largest providers of computing infrastructure. Building that infrastructure required spending money before all the future revenue existed. AI could follow a similar path. If demand continues growing and customers are willing to pay enough for AI services, today's investment could create highly valuable assets for decades. And that brings us back to the central question. A company doesn't create value simply by spending money. Eventually, the assets it builds need to produce a return. Imagine spending $1 million building a rental property that only generates $20,000 a year. The building might be impressive, but financially, you've got a problem. The same principle applies to AI infrastructure, just with vastly larger numbers. The question isn't, is AI useful? It almost certainly is. The financial question is, will the revenue and profits generated by AI justify the enormous amount being invested? Those are two very different questions. there's another layer. When companies have enormous cash flows, they can fund a lot of investment themselves. But as the AI infrastructure build-out becomes larger, debt and other forms of financing are also becoming increasingly important. And debt changes the equation. If you build something entirely with your own cash and the returns disappoint, you've made a poor investment. But when debt is involved, interest still has to be paid. The debt eventually has to be refinanced or repaid. That doesn't make debt bad. Businesses use debt successfully every day, but it does mean the investment eventually needs to generate enough cash to support the financing behind it. And this is where the AI boom becomes more complicated. The largest technology companies aren't the only ones building infrastructure. Specialist data center companies, cloud providers, and other businesses can borrow money to buy expensive AI equipment. Technology companies can invest in AI businesses. AI businesses can then spend money buying computing capacity from technology companies. Chip makers can invest in companies that become customers for their chips. None of these relationships automatically means something is wrong. Strategic investment between suppliers and customers happens in many industries. But when suppliers, customers, investors, and lenders become increasingly interconnected, investors need to understand where the money ultimately comes from and who is carrying the risk. Imagine I lend you money. You use that money to buy a service from me. I can now report more sales. That doesn't necessarily mean anything improper has happened, but it does mean we need to ask an additional question. Was the demand ultimately created by an independent, profitable customer? Or was financing required to create that demand? Scale that question up to billions of dollars and it becomes very important. The healthiest long-term AI economy would ultimately be supported by businesses and consumers paying for AI because it creates enough value for them, not simply by more money continuously flowing around the AI ecosystem. Which brings us to perhaps the most important word in the entire video, monetization. That simply means turning AI usage into money. Companies can monetize AI through subscriptions, cloud computing, advertising, enterprise software, automation, AI agents, and entirely new products that haven't even been invented yet. The opportunity could be enormous, but usage alone isn't enough. Millions of people using an AI service doesn't automatically make that service profitable. What matters is how much revenue that usage creates, compared with what it costs to provide it. There is a very strong argument for why all of this spending could work. AI adoption is still relatively early. Businesses are only beginning to redesign workflows around it. AI could improve productivity, reduce labor costs, accelerate research, transform software, and create entirely new industries. If that happens, demand for computing power could continue increasing for years. Today's apparently enormous data center investment might eventually look similar to earlier investment in railways, electricity, telecommunications, or the internet. Infrastructure built before the full economic opportunity became visible. But there's another possibility. Competition could push AI prices down. Models could become cheaper to run. Companies might build more computing capacity than customers eventually need. Some AI products might attract millions of users but struggle to generate sufficient profit. And infrastructure financed with debt could become more difficult to support if expected revenues don't arrive. The danger isn't necessarily that AI fails. AI could transform the world, and some AI investments could still lose money. We've seen that pattern with transformative technologies before. The internet provides a useful comparison. In the late 1990s, investors were right about something extremely important. the internet was going to change the world. What many got wrong was how much some businesses were worth and how quickly the profits would arrive. When the dot-com bubble burst, the internet didn't disappear. Quite the opposite. It continued transforming almost every part of the economy. But many investors still lost enormous amounts of money. Being right about a technology doesn't automatically mean you're right about every investment connected to it. So how can an ordinary investor monitor this without reading hundreds of pages of company accounts? Start with 4 things. First, CAPEX. Look at company earnings releases and investor presentations. Is capital expenditure continuing to accelerate? Second, free cash flow. After paying for all this infrastructure, how much cash is the business actually generating? Third, debt. Look at whether borrowing is rising and whether interest costs are becoming more significant. And fourth, AI revenue and margins. Are companies beginning to show that AI products are generating meaningful revenue and eventually profits? You don't need to predict exactly where AI goes. You're looking for evidence that the economics are beginning to support the investment. And you don't need expensive financial software to find most of it. For US listed companies, start with the company's investor relations website. Look at quarterly earnings releases, presentations, and conference call transcripts. For more detail, the company's 10Q and annual 10K filings are available free through the SEC's EDGAR database. Search within those reports for terms such as capital expenditure, free cash flow, debt, data centers, and AI revenue. You don't have to read every page. You're looking for the trend. So when you see another headline announcing another $50 billion of AI investment, don't automatically assume it's good news, and don't automatically assume it's a bubble either. Ask a simpler question. What return is this money expected to generate? Then follow the evidence. Is revenue growing? Are margins improving? Is free cash flow supporting the investment? Or is debt increasing faster than the economic return? Those questions matter whether the technology is artificial intelligence, railways, property, or factories, because ultimately capital has to earn a return. Artificial intelligence may turn out to be one of the most important technological developments of our lifetime, and the infrastructure being built today may eventually prove to be extraordinarily valuable. But technology and investment aren't the same thing. The AI boom is now requiring enormous amounts of physical infrastructure capital and increasingly sophisticated financing. So rather than trying to predict whether AI succeeds or fails, investors can watch something much more measurable. Follow the money. Watch the spending, watch the debt, and most importantly, watch whether the profits eventually arrive. If you found this useful, subscribe to Practical Assets. We explain investing, markets, and financial concepts without making them more complicated than they need to be.